Hey guys, Brian's here. Today's Thursday, December 28th, 2023. The market is closed, and in my opinion, trading spreads is the smartest and probably the least riskiest way to trade the S&P 500, especially when you're using the SPX options. I'm going to demonstrate a couple examples with price action here this week. We're going to be taking a look at a butterfly spread and then comparing it to a long call option. If we take a look at the price action here, this is the SPX on the right and this is the SPY on the left. I think we can all agree that this has been some of the most horrendous or ugly price action that a lot of us have seen. If I were to just maximize this and let's make it a little bit larger, as you guys can take a look right here, this is the epitome of chop in terms of day trading. If we take a look at where the market closed here the previous day, this is where it closed here yesterday, and then this is where it closed here today. So it has essentially gone from here to here. From a net change perspective, it is virtually going nowhere. We're talking about less than a 15 point range here on the SPX from a net change perspective. That is pretty disgusting, and that can lead traders to make poor decisions or trying to scalp in an environment or try to scalp in a market that's not really easy, or for lack of better words, we'll say the climate. This isn't the climate for scalping or for momentum trading, and this is where a lot of traders will tend to give back profits. Majority of the time, the market is actually choppy. It does not trend that much, and that also leads traders to make poor decisions because it's very easy to get addicted to a nice big juicy trend and then think that's going to happen every single day of the week. And then if we take a look at a larger time frame, you guys will see the same thing. Let's jump back to the SPY. The reason I have the SPY up is because I do most of my analysis on the SPY and then I trade SPX options. So we're going to focus on the SPY for a second here. All of these levels that you guys see on my charts are drawn in, so let me just clear this out. I have no indicators on this chart other than the standard VWAP that is shipped with just about every charting platform or software out there, as VWAP is very important for day traders. In my opinion, is one of the most useful indicators there is out there, and it's probably the only one you'll need, to be honest, for a day trader. Okay, now as we take a look at these levels come from what's called gamma exposure. If you're new to this YouTube channel, I've been sharing these gamma exposure levels at the start of the week. I do an analysis and then I've been sharing them, and then this week I've been able to pump out a few more videos as I had a little bit of extra time. It is low volume, low volatility. It's the end of the year, so things have slowed down across the board, and it's provided me with the time to actually create a lot more videos for you guys. So if you'd like to learn a little bit more about gamma exposure, I just recommend you guys check out the previous videos. The links will be in the description down below. If you're watching this video in the future, I highly recommend you just review all the videos that I've put out for the month of December, as I was able to pump out a decent amount this month here, and these largely are pertaining to the gamma exposure. I've been doing a recap so we can see how the levels interacted with price. So I do a video at the start of the week, and then at the end of the week we have a recap so you guys can actually see how price action has interacted with the levels. Because at the start of the week I'll say something like there's probably going to be a lot of liquidity around this AG strike. This is the absolute gamma strike. Price will be pretty choppy around here. The absolute gamma strike will tend to act as some sort of a magnet, and then we can see this has been that magnet. So for 2 out of the 4 trading days, look at how much time price has spent around this absolute gamma strike here. 475 was what I called a super strike, a key strike, whatever you want to call it for this week. It is significant. So that's pretty important to take away. If you've never heard about gamma exposure, there's a link in the description down below on a playlist. So all these levels that you see are drawn from that. Again, it's been done step by step in previous videos, but the video specifically for this week is this one right here. This is where the levels are drawn out at the start of the week. These previous 2 videos, I shared some of my live trades that I actually took utilizing the same information. The butterfly spread that we're going to be taking a look at it in this video is not one that I ran live. I shared the trades that I took live in the previous 2 videos. This is just a byproduct of, I had a one-on-one with a trader here today, and we were discussing different opportunities and spreads as he's trying to plan out how he's going to trade in 2024. And we were talking about different approaches to the week. I was sharing some of my approach, and that made me realize that there was even a simpler way for me to approach this week. As you guys know, if you've seen the previous videos, I opened a 0DT, 1DT, a 2DT, and a 3DT trades at the start of the week. I essentially had a plan for every day of the week, and I ended up swinging most of them. But I'm always asking that question, how can I simplify my trading even more? How can I even take less trades? How can I swing more? How can I have more time for other things outside of just trading? And using spreads is a great benefit for that, especially when the market is choppy. The reason gamma exposure is important for this type of video is because understanding the dynamics between price action and gamma exposure can help lead you to take smarter trades. The first thing to take note of is the fact that the market is in a net positive gamma environment. That means we're going to expect reduced volatility. Reduced volatility will generally lead to price action rising, and it will generally lead to choppy price action. Those two are what we tend to expect whenever the market is in a net positive gamma environment. If it is the opposite, then we would expect the opposite, meaning if the market is in a net negative gamma environment. Again, I highly recommend you check out any of the previous gamma exposure videos. Do your research on that. That right there will probably increase your trading potential tenfold, just understanding the dynamics of price action with the SPX, with the SPY in relation to gamma exposure. So as we take a look at this chart right here, this key strike 475 is significant. On top of that, on Tuesday, which was the start of this week, the market was closed on Monday. Otherwise, it would have been a Monday. The price was holding over VWAP. Once we broke out above 475 and we see VWAP rising, we have no real reason to think the market is going to go down. If, however, it broke these levels, then we have something else to consider and think about. We're not trying to predict the future. We're just analyzing the information and the data we have in front of us and then trying to create low risk, high reward scenarios or high probability scenarios, because generally whenever you're taking a high probability trade, you may tend to have more risk out. The butterfly spread is probably the best balance between the two. On top of that, it is very versatile and flexible. So if we head over to one of my favorite tools, as you guys know, is Option Strat. This is the butterfly spread that we will be looking at. I'm going to just briefly mention why these strike prices are selected, because that's usually going to be the type of questions I'll get whenever I put out a type of video. And that's why I had to spend those few minutes just discussing gamma exposure. In the future, I won't always be explaining exactly why this strike was chosen, why not that strike, because the ultimate goal for me is just to get these videos to be shorter and shorter. And another objective is to try to simplify these videos, because I know a lot of newer traders are missing out on the significance of this style of trading. I know at least for my first year or two of trading options, I didn't really dive that deep into spreads because A, it seemed too complicated, or it just didn't seem as something that was a necessity. And then the more you trade it, you realize how simple it can be, and then it can actually reduce a lot of stress from your trading, and then you can actually trade it in more environments, because if the market is actually choppy more times than it trends, it means you have more opportunity to trade during a choppy market, and you can create slight biases for yourself. So if we take a look at the SPY and the SPX now side by side, this 47.70 strike, I went ahead and just marked that on the SPX as it is the similar correlation to the 475 strike here on the SPY. So these two essentially line up, and then we have this green dash level here essentially lines up with this green dash level here on the SPY. So that was just to create some sort of reference between the two instruments, because again, we are trading SPX options. So we just want to be able to have some sort of an understanding of what we're targeting. But this is that 4,800 level. The reason we're targeting 4,800 level comes from the gamma exposure. It comes from understanding what happens when the SPY is in a positive gamma state. It also comes from understanding when price is holding above these significant gamma exposure strikes, what happens. So that's why 4,800 is the strike in which we are going to use as our target for this butterfly. On top of that, if we take a look at, this is a gamma exposure profile, by the way, 4,800 is a significant strike here for the SPX options for this week. So if we scroll all the way back, I'm just going to scroll back in time here and see this is December 19th. Let's go to the start of this week, which was the 26th. So as I'm coming right here, here's the 26th. Just picking a random arbitrary time here. Let's just see if we just jump to, sometime early in the morning on the 26th here. So this is 10:51 Eastern time, random time. I'm just choosing earlier in the week. So this is the start of the week. This is when it was a 4 DTE. Boom. 4,800 stands out. You can probably show this to a 5-year-old and say, hey, show me the biggest green bar you see on your chart. And they're going to say that one, mommy or daddy. Boom. It's very simple to see. 4,800 level. It's significant. We want to mark it on our chart. We want to be aware there's the possibility of that. Without understanding anything else more than that, we can all agree this is a big, giant green strike. All the other stuff has been explained in the previous videos. Again, the significance of all these other levels, but we do know we are holding above this one. So naturally, we're going to tell ourselves price might want to gravitate towards this strike price here. If you were to just buy the 4800 call, that's where you can run into some trouble. So if we take a look, this is the 4800 call. So we'll start with this. This is probably what one trader might think. Oh, if I think the market's going to go to 4800, I'm just going to buy the 4800 call. This is the Friday expiration. So for tomorrow's expiration, let's take a look at the historical data for that chart. The entry for this trade, in my opinion, would have happened right around here, because this is as we are breaking out and holding. This is VWAP also rising. It is just coming out of lunchtime here, or if we wait till the end of lunchtime, you have some sort of technical pattern forming and you want to buy the breakout, whatever. I'm just using this point here. None of that is relevant. Let's just say this doji candle that formed right here. This is where we're going to decide to enter this trade here. This is 12:30 between 1, anywhere in this vicinity. If we check out, that would be right around here. So we're looking at this call contract going for around 10, 30, 11 bucks or so. So 1100 bucks. And we can see what it's going for right now, $585. So this trade is down over 600 bucks. At one point it hit a high of 13 and change. So yes, it was up about 400 bucks, but that trade is because of this price action that occurred right here. We had a nice little breakout and price did end up rising earlier in the week. However, after that, price has been virtually chopping around. Theta, which is time decay, has been chewing up that option, and that can lead to an exhaustion of trading, because if you're looking at the charts, you're going to second guess every single minute that the SPX is doing this. This is going to essentially drive you crazy, and that leads to traders taking boredom trades or making improper decisions or just doing things that are probably not that smart to do, because we're human. If we're sitting there in front of our charts and we see all this happening, we're looking at our P&L and we're seeing stuff move all around, we almost feel inclined to do something, and that's usually what leads to, again, not the greatest trades. And price action is going to play, for lack of better words, these psychological games with us, and we want to try to put ourselves in situations to avoid that. So if you've been trading for a few years, you've been trading options, and you find it very mentally taxing, and it's sometimes discouraging, and it can exhaust you because a lot of the times the market is choppy. Next year we're going into an elections year. Yes, there will be some sort of spike, but in implied volatility. But let's just say out of the 12 months next year, 8 out of those months, it is just a bunch of price action like this, and the only real movements we get are around the CPI reports or the FOMC reports. So whenever, you know, some major news catalyst comes out, we get a nice big trend, and then every majority of the other days you're just dealing with quote unquote disgusting, horrendous, choppy price action. What are you going to do? Are you going to continue to force yourself to take boredom trades? Or are you just going to sit on the sideline and miss out on the opportunity to take smarter trades like a butterfly spread that I'll be showing you guys in a second? Or will you just have a downtrending P&L because you're scalping and trading in an environment that isn't fit for your style of trading? If you can expand your repertoire, if you can expand the strategies you use, that can make you a lot more, that can make you a much more versatile or well-rounded trader. And that is the intention behind what I'm trying to share in this video here. So if we jump now to the butterfly spread, the reason I'm using this 47.60 call is because at the start of this week, let's just say price is above this strike price here, and you don't know if it's going to go to 4,800. You want to give it a little bit of room. We're using this 47.60 call here, and then we're also using this 48.40 call, which is all the way up here. So 48.40 is up here, so boom and boom here, and then this is the midpoint of that. So in a sense, this is what that butterfly would look like on this chart. It looks like this triangle here. I'm just flipping it on the side, and it looks something like this. So everything in here is your profitability zone. If we take a look, this is what this trade would have looked like at the start of the week. So again, I did not run this trade live. I went ahead and then inputted the information for if this trade was open. As you guys can see here, I saved this at 4:48 p.m. today. So after the market closed, I decided to just save this again to be able to showcase this video. Where did I get that 11.50 for the price of the option? I went ahead and just took a look again around that time here. This is 1 p.m. Eastern time here. So December 26th, the Tuesday, right in the middle of the day, right when this would have been the ideal time, in a sense, when we had confirmation in price and so forth to decide to get in the trade. So I'm just using that as an idea for how much the butterfly spread would have cost at that time. You guys can see this trade is up 800 bucks from Monday. In contrast, the call is down around 600 bucks from not Monday, from Tuesday. If we head back to this here, that is the first thing to understand. These are two positions both targeting 4,800, the butterfly and the long call. The butterfly has been doing much better. On top of that, if we take a look at the P&L curve, you guys can see this has just been a nice, smooth, steady up climb. In contrast to the call option, if I were to just make this a line chart, you guys can see this has been one nice little pop, and then it has just been this decline that is a little bit more volatile, we can say, because it has had moments in which it went up, up, and then sideways, down, and so forth. In contrast, this is much easier to hold. If we were to zoom in a little bit more here, we can see there's a little bit of a decline here, and then it just continued, but it didn't take out your previous low. So in other words, if this is a graph of your P&L for the week and you're in a position like this is much easier to hold versus something like this. And yes, when you trade, you should not be staring at your P&L. I'm just talking about hypothetically speaking. As we know, all of us are traders. We will look at our P&L regardless of how disciplined we are. We want to be able to gauge how is the position doing. This is easier to hold. Now, why did this trade work out so well? That is the dynamics of a butterfly spread. So this is, in a sense, what it's going for now. So that's why I made sure to just go ahead and mock it up so you guys could have seen what it would have looked like here earlier in the week if we were to open it. Now, another person might look at this and say, well, what happens if the SPX was to continue to go higher and higher? That is where you can turn this into a broken wing butterfly. But before we get to the broken wing butterfly, I want to point out the break evens on this trade. This right here is the break even, 47.71. So let's just call it 40 70 70, right, just to keep it simple. And then the break even to the upside, let's just call this 48.28, keep it nice and even. So as we take a look, let's actually just round this up to 30. So 48.30 and 47.70. We head back to the chart. This is 47.70 and this is 48.30. So right, so this is our nice sweet range. Why am I looking at 47.70? Because of our analysis that we did at the start of the week, because of price action holding above this level. Obviously, if it broke down below this level, we probably would not be in the trade anymore. The advantage though is as long as price is above this level, that butterfly spread will be green. In contrast to that 4,800 call, because here we are, price is still above that level, but that call option is down almost 60%, even though price action has gone up. That is very frustrating to a trader because it means at the start of the week, you're telling yourself, hey, the SPX is going to go to 4,800. And now you had to sit through all of this choppiness. Even if you're disciplined and you're a swing trader and you decided that you weren't going to touch the trade, you're still looking at your P&L and you're seeing that you're down even though price is up. And that is very frustrating. In contrast, the trader that decided to run the butterfly spread is not concerned about that because as long as price is above here, their P&L will be green. If price continues to go too high, yes, this trade will be in trouble. But if we take a look at the chart, look at how much room there still is all the way up to here before you have to worry about that. Price has to get past this strike price and then consolidate probably for a little bit and then push a little bit higher. So you'll have plenty of time to decide if you want to do anything. The moral of the story is you'll actually be in profit at this point. So you can just close out the trade for a profit, or you can do something if you want to continue and hold the trade. Something that I like to do is make these trades broken wing butterflies. All that means is right now this is a balanced, it's nice and even. The wings are exactly the same distance from the short strike. So these are referred to as the wings right here. And all we're going to do is just break one of the wings. So by pulling this in, we are breaking this wing. And you guys see by pulling that strike price in, what happens to the risk profile here. That right there means we have eliminated any risk to the upside. It doesn't matter how high the SPX was to go now. This trade will still be green. It's still going to be positive the same amount. And what did it cost us? Just a little bit more. So if we go back to what this trade actually looked like, this is the cost of this trade here. Hypothetically speaking, if it was open midday at the start of this week, as we already addressed that, how much more would it have cost us to actually make this a broken wing butterfly? As I pull this in right here, boom, 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 I'm just pulling it in right until the point this eliminates any upside risk. And we can see now it's going for less than $200 more. That is, I think, pretty significant to take note of, because half the time, if I'm mocking up a butterfly spread, I might look at this and say, hey, how much more is it going to cost me to just make it a broken wing? And as I take a look at this and I say, oh my God, that's less than $100, an extra $1 more. It's almost a no-brainer, in my opinion, to just grab this, because now it doesn't matter how high the SPX was to go. You're not going to have to worry about ever seeing red to the upside. So now all we're telling ourselves is, hey, as long as the price remains above our key strike, which is this one for the week, we're green. And that already eliminates so much anxiety and so much concern, because now we're saying, hey, if we're anywhere above this strike price, we don't care how high it goes. The only instance in which we're wrong in this case is if this SPX was to start breaking below this area here. But we did our homework, we did our analysis, we have some sort of conviction in addressing this, and then the next step is just assigning some sort of risk to the trade. So in this case here, we might say, hey, for this I'm going to risk maybe $3 or so $300. That ends up being whatever percent, maybe 27%, 26%. That's what we're risking, and we'll see how it works out. In this case here, it's an $800 trade using, I'm just going to round it down and say a $1,000 position. So let me just make it unbroken wing, easier numbers. So let's just say for $1,000, this trade is now up over $800. At one point today, it was up over $900. But let's just say you're talking about almost a 90% return. We'll use 80% return. Actually, we'll use 75%. This is a 75% return on one of these. We're not scaling up. So if we were to scale up, let's just say you're trading with a larger account size or so, and you're in about 5 of these, and you're using around, we'll say $5,000 or so to trade something like this. This is an opportunity where even if you were trading with a $15,000 account or a $10,000 account, which in my opinion is a good sweet spot for people that trade, that are now trading margin, now trading on margin, now trading spreads for the first time. A $10,000 account opens the doors for you to trade a lot of different types of different option strategies out there without using up too much margin. This trade only requires $1,100 in margin in this case here. So as a 10% of how much margin you have in your account. And if you're using good, principles, you never want to risk more than 3% of your accounts or never more than 2% of your account. Everybody has different measures, but let's just say you're using that standard, never risk more than 3% of your accounts on a trade. That means you can open up something like this and you can give this trade almost a 30% stop loss, which is going to be around $300, which is close to how much is which is exactly 3% of your portfolio with a $10,000 account. And this type of trade actually opens the doors, or you have the opportunity to trade this type of way. This is a case in which it works out. An $800 return is an 8% growth on your account for the week, where you took one trade based on one analysis to start the week. You're risking $300 to potentially make a couple $1,000 again if if things work out perfectly, and then you hold all the way till expiration, which is not encouraged. But yes, there's the opportunity here to make $2,100, which is, in my opinion, if you're holding until tomorrow's close, you're risking too much if your account is that small, because anything can happen. But for the most part, let's just call it that you take profit here today, because tomorrow's Friday. You don't want to deal with obviously any type of gap towards the end of the week or anything weird or strange happening, and you decide to take that return. That is an 8% return on a $10,000 account with one trade. So your commissions are low. You have one conviction. You did one analysis. The video that I did at the start of this week here was less than 20 something minutes, if I remember correctly. After you get familiar with, plotting your levels at the start of the week using any type of tool, whatever edge that you have. In my case, it happens to be these gamma exposure levels in conjunction with a couple other tools that I would use. But in this case here, I did my analysis at the start of the week. That's 30 minutes worth of work. Then the market opens, wait a little bit, see how price action interacts around here. It's doing what was expected. I'm now looking at a risk profile. I'm analyzing some other trades. It's now, 11 o'clock or so Eastern time here. So a few hours into the market open. So let's just call it 2.5 hours into market open. So now we're looking at 3 hours. So this is 3 hours into the week, and we're now executing a trade. And you're letting theta time decay do its job. You've already done your analysis on, risk management. You've already allocated the amount of margin for the trade that's adequate for your account size, and you're making $800. In this case here, it is a 8% return on a $10,000 account. And at any given moment, you weren't necessarily stressing, because the moment you opened the trade, you were continuing to see a green P&L curve continue to have a gradual uptick, in contrast to buying the call. There's no, to my knowledge, or at least I know for me, I in my right mind cannot buy a weekly call option and just sitting it without just setting an alert like this and saying like, hey, I'll check back on the chart, with whatever. I have an alert down here for if we broke down below this level, and then had an alert up at the 4,800 level on the SPX to see if it was necessary. I've closed out most of my trades here. The only thing I have left is an iron condor for tomorrow, but that's the topic for another video. In this case here, I just wanted to hopefully shed some light on this. I wish this is the type of information I came across sooner, and that's why I'm really trying to showcase and sharing this. I think next year I'm definitely going to be talking a lot more about butterfly spreads. I've covered calendar spreads a lot on this channel. I've covered butterfly spreads and broken wing butterfly spreads before, but I'm really going to make it a habit to try and introduce, or at least talk about it, showcase it as much as possible for newer traders, because I think a lot of you guys get discouraged because this is not showcased enough, and it's not something that is properly, at least, compared from one to the other. Why use one versus the other? Obviously, this is not a beginner friendly video. You still need to have some sort of understanding of how to execute a butterfly spread, how to submit the order on your platform. I can do those types of videos, or you can just look it up yourself. That is very beginner elementary. You can just search, how to open up a butterfly spread or something like that. The important thing to take note is, how do you read a risk profile? I'll leave a link in the description down below on how to actually, use Option Strat. It's a great tool. It is, in my opinion, the best tool for option traders out there for analyzing risk and actually being able to mock up your spreads. It's very user friendly, in my opinion. The UI looks beautiful. I wish I designed and built it myself, to be honest. Somebody beat me to it, so it's out there and it exists, and that's why I talk about it a lot. In contrast here, it's also a tool I use frequently, so that's why it's constantly being showcased in almost every video in which I do. This is my style of trading, so I'm just showcasing exactly what I do, my thought process behind it, and then hopefully it can help a newer trader, or it can help a more seasoned intermediate trader, because maybe somebody with a little bit more experience wouldn't have made it broken wing. Maybe you just stick to your butterfly spreads. Maybe I've introduced you to something about gamma exposure, and that can help in assisting your spreads. The joy is in knowing that there's so much information out there, and we're living in a time where trading has become so much easier because of our access to data and tools. Gamma exposure is not something that was popular 5-10 years ago. It was probably something that was held for the elites. Now we have so many different ways of actually calculating this information, getting the information, and it just comes down to focusing more on how we're going to apply it to our trading. Using spreads, using the flexibility and the versatility of spreads, creates the opportunity for us to be able to have more time for other things outside of trading, because we're eliminating one of the major risks with buying options, which is having a negative theta. But for some people that don't like credit spreads require sometimes a little bit too much margin, and they can be very risky if you don't know what you're doing. If I can, I would rather open up a butterfly spread over a credit spread, because a credit spread, sometimes for how much margin you're using, you're not going to get that much of a return. So in this case here with this butterfly spread, we're just using $1,000. I don't think there's a credit spread that exists out there that could have returned $800 just using $1,000. Yes, the probability of profit would have been higher if I were to mock it up for curiosity. So let's just see. I'll wrap up on this, but let's just see a bull put spread to start this week here. We have the same thought process. We're going to 4,800, but we know our level is 4,770. Let's just say we're going to run a really wide bull put spread. Let's make it a little tighter because we're going to try to match the margin. So $1,000 in margin. Let's take a look here. Earlier in the week on the 26th, the credit received would have been $4. So the max amount this can make is $400. That is the max amount this credit spread would have been able to receive at the start of the week. In contrast to a broken wing butterfly, that's equally going to use a little bit more than $1,000, but the max this can make is $2,700. If the market just blew away past this level, this is still going to make $295, which, being realistic, is about how much, or the maximum, I think any type of credit spread trade is going to hold for. You're generally going to look for 50% your credit received. So if you were receiving $400 in credit, then you're probably going to take profit once you're up $200. So for $200, as a credit spread trader, if you're selling a at the money bull put spread, which is not the way most people are going to trade these types of credit spreads, you're probably going to go something that's out the money just to have an even higher probability of success. That's the main reason people trade these types of credit spreads to begin with. The point in which I'm trying to make is, you're not going to, the opportunity to make as much is not as high with something like this, and then you still have the same curve. You still have no risk to the upside. And if you take a look at this here, there's no risk to the upside. You still have very similar break evens, but you have the possibility of making over 100% returns. Sometimes it's 2, 3, 4, 500% returns. That's just not something that is achievable with verticals. And that is one of the main reasons why I talk more about butterfly spreads and calendar spreads on this channel, it's because my background is in trading momentum. I was an options buyer for a while, and I still like to be able to have that opportunity to have hundreds of percents of return. Doesn't mean I'm aiming for that, but just knowing that there is that potential is one of the main reasons I trade this way. And that's why a lot of the times I label myself more of a hybrid trader, because I will still buy options here and there, but more times than not, I'm trading spreads as if I was still thinking about it from that perspective. Hopefully this video sheds some kind of light. Prepare to see a lot more of this on this YouTube channel next year, as I'm comparing and contrasting the risk and the trade-offs behind trading one particular type of spread versus just buying the option. If you enjoyed this video, leave a comment down below. If you've enjoyed the amount of videos I've been able to put out in December, let me know in the comments down below too. I will try to upkeep this type of volume. I do know there's no way I can upkeep putting out this amount of videos, because as I've mentioned in previous videos, I'm a filmmaker, and no way I'll have the time to be able to put out this many YouTube videos. And I'm also a developer, I'm a programmer. So if I'm coding and there's a lot of bugs, or I'm working on a new feature for gamma exposure, then it means there's less time to work on these types of videos. So that's why I wanted to utilize this time for December while I had it, and then you guys can rewatch a lot of these videos in the future, because the principles will be exactly the same. Thanks for watching, guys. Like the video, share it if you learned something, and I'll catch you in the next one.